Have you ever stopped to wonder how a country can become an economic superpower without the one institution that nearly every modern nation now considers indispensable? Today, the Federal Reserve influences interest rates, banking stability, inflation, and the flow of money throughout the American economy. It is so deeply woven into everyday life that many people assume it has always existed. But for more than a century after the United States declared its independence, there was no permanent central bank guiding the nation's financial system. No institution stood ready to calm markets during panic. No single authority managed the money supply. No official lender of last resort waited behind the banking system when fear spread across the country. Yet, during those remarkable years, the United States transformed from a fragile republic struggling to survive into one of the fastest growing economies the world had ever seen. How is that possible? The answer is neither simple nor comfortable. It is a story of ambition and failure, brilliant ideas and devastating mistakes, political rivalries, collapsing currencies, and ordinary people who paid the price whenever the financial system broke apart. To understand why America eventually embraced a central bank, we first have to return to a time when the young nation barely had a financial system at all. When the American colonies declared independence in 1776, their greatest challenge was not only defeating the British Army. Winning a revolution required food, weapons, clothing, transportation, and soldiers willing to keep fighting through years of hardship. Every one of those necessities depended on money. But the Continental Congress faced an impossible situation. It had no reliable power to collect taxes across the colonies, no national treasury filled with gold or silver, and no mature banking system capable of financing a prolonged war. Faced with overwhelming pressure, Congress turned to the quickest solution available. It began issuing paper currency in the hope that future prosperity would eventually support its value. At first, the plan appeared to work. The notes circulated through towns and villages as merchants accepted them in exchange for goods and services. But every new military campaign demanded more supplies, and every new supply order required more paper money. As larger quantities entered circulation, confidence began to weaken. Prices climbed higher. Families discovered that the same notes bought less food than they had only months earlier. Farmers became reluctant to exchange valuable crops for paper that seemed to lose purchasing power almost every week. Before long, inflation accelerated into a crisis that reached nearly every corner of the struggling republic. The damage extended far beyond economics. Soldiers risking their lives for independence found their wages becoming nearly worthless before they could spend them. Shopkeepers hesitated to accept government notes. Communities increasingly relied on barter because many people trusted livestock, grain, tools, or silver coins more than printed promises. The financial instability threatened morale as much as military defeats. Long before the United States became known for economic strength, it experienced the painful consequences of a collapsing currency. That experience left a lasting impression on the nation's founders. They had witnessed how excessive money creation could destroy savings, disrupt commerce, and weaken public confidence. For many Americans, centralized control over money became associated with danger rather than security. This deep suspicion would shape political arguments for generations. Every proposal involving banks, credit, or federal financial authority would eventually encounter the same difficult question: how much power over money should any government possess? As the Revolutionary War ended and independence became reality, another enormous challenge emerged. The new nation had won its freedom, but victory came with staggering debts. Individual states owed large sums borrowed during the conflict. The federal government also carried heavy obligations to soldiers, foreign lenders, and suppliers. Confidence abroad remained fragile because many investors doubted that this experimental republic would survive long enough to repay what it owed. Without credibility, borrowing would become expensive, investment would remain limited, and economic growth could stall before it truly began. Into this uncertain moment stepped Alexander Hamilton. His personal story differed dramatically from many of America's political leaders. Born outside the mainland colonies and raised under difficult circumstances, Hamilton possessed extraordinary intelligence and relentless determination. During the Revolution, he earned the trust of George Washington, and after independence, he became the nation's first Secretary of the Treasury. The problems before him were immense, but Hamilton believed they could be solved through bold financial reform rather than cautious improvisation. Hamilton viewed public credit as the foundation of national strength. In his eyes, a government that honored its debts would attract investment, encourage commerce, and earn respect from foreign nations. He proposed that the federal government assume many state war debts, creating a unified national financial obligation instead of a patchwork of competing liabilities. Just as importantly, he argued that America needed a national banking institution capable of managing government finances, supporting trade, and bringing greater stability to the country's monetary system. Not everyone welcomed these ideas. Many Americans feared that concentrating financial authority in one institution would benefit wealthy merchants and powerful investors while leaving ordinary farmers behind. Others questioned whether the Constitution even granted the federal government such authority. To them, the memory of worthless wartime paper money remained fresh, and any expansion of centralized financial power seemed like the first step toward repeating old mistakes. The debate quickly grew into something much larger than a disagreement over banking. It became a struggle over competing visions of the nation's future. One side believed that a stronger financial system would encourage prosperity, strengthen the union, and provide stability during future emergencies. The other feared that centralized institutions would gradually accumulate influence until political freedom itself was threatened. Neither side viewed the issue as merely technical. They believed the outcome would shape the character of the United States for generations. As arguments intensified inside the young republic, the future remained uncertain. The country desperately needed stability, yet many citizens distrusted the very institutions designed to provide it. Hamilton stood convinced that a national bank offered the best path toward lasting prosperity. His critics believed it could become a powerful instrument serving privileged interests instead of the public. Their confrontation would become one of the defining political battles of early American history, setting the stage for decades of conflict over money, power, and the question that still echoes today: who should control a nation's financial future? The political struggle that followed was never simply about creating a bank. Beneath the speeches, newspaper editorials, and heated debates in Congress lay a much deeper question: what kind of nation would the United States become? Alexander Hamilton believed that economic strength required national institutions capable of inspiring confidence at home and abroad. His opponents believed that concentrating financial power in one place would slowly erode the very freedoms the Revolution had been fought to secure. Both sides claimed they were protecting the future of the Republic, yet they envisioned two entirely different paths toward that future. After months of fierce argument, President George Washington ultimately accepted Hamilton's reasoning. The first bank of the United States received its charter, becoming the largest financial institution the young nation had ever seen. It was neither fully public nor entirely private. The federal government held a significant ownership stake, while private investors supplied much of its capital. The arrangement itself reflected compromise. Hamilton hoped the bank would strengthen government finances while encouraging private enterprise, linking national prosperity with the success of American commerce. Almost immediately, the new institution began bringing greater order to a fragmented financial landscape. Government revenues could be collected and managed more efficiently. Credit became easier to obtain for businesses engaged in trade and manufacturing. The circulation of money became more reliable across different states, making interstate commerce less complicated than it had been during the chaotic years following independence. Foreign lenders, who had once questioned whether the United States would survive, gradually developed greater confidence in the country's financial credibility. For merchants and investors, these changes represented real progress, yet success did not silence criticism. If anything, it intensified suspicion. Many Americans looked beyond the bank's practical achievements and focused instead on the principle behind its existence. They feared that economic power naturally attracted political influence. If one institution controlled large portions of government finance, what would prevent it from shaping public policy for its own benefit? These concerns were especially powerful among farmers and frontier communities, who often believed that financial decisions made in distant cities rarely reflected their everyday struggles. Among the most influential critics stood Thomas Jefferson. He imagined an America built primarily upon independent farmers rather than financial centers. In his view, widespread land ownership produced responsible citizens capable of protecting Republican government. Concentrated banking power, however, threatened to shift influence toward wealthy commercial interests. Jefferson worried that financial institutions would gradually become stronger than the elected representatives meant to oversee them. James Madison shared many of these concerns, arguing that constitutional limits existed for a reason and should not be stretched whenever government officials considered a new policy useful. The disagreement between Hamilton and Jefferson soon evolved into something much larger than economic policy. It marked the beginning of competing political philosophies that would shape the nation's future. Supporters of a stronger federal government generally favored Hamilton's approach, believing coordinated national institutions were essential for growth. Advocates of limited government viewed Jefferson's warnings as a necessary defense against centralized authority. Their rivalry established ideological divisions that continued influencing American politics long after both men had left office. For 2 decades, the first bank remained an important pillar of the nation's financial system. Commerce expanded, government borrowing became more organized, confidence steadily improved, but politics rarely rewards stability for long. By the time the bank's charter approached expiration, the balance of power in Washington had shifted dramatically. Many legislators remained unconvinced that the institution deserved another 20 years of authority. Others saw an opportunity to weaken an organization they believed had accumulated excessive influence. When Congress debated renewing the charter, the vote proved extraordinarily close. Supporters emphasized the bank's record of improving financial stability. Opponents argued that no successful institution should become so powerful that it appeared indispensable. In the end, renewal failed by the narrowest of margins. The first bank closed its doors, ending one of the nation's earliest experiments with centralized finance. Its disappearance quickly exposed problems that had previously remained hidden. Without a strong national institution encouraging discipline, state-chartered banks multiplied at remarkable speed. Local governments eagerly approved new banks because they stimulated regional economic activity and expanded access to credit. Entrepreneurs welcomed the opportunity to borrow money for new ventures. Land speculation accelerated. Optimism spread across much of the country. However, rapid expansion also encouraged risky behavior. Many banks operated with limited reserves while issuing large quantities of their own paper notes. Because each institution backed its currency independently, the value of one bank's notes could differ significantly from another's. Travelers often discovered that money accepted in one state lost purchasing power after crossing a state border. Merchants faced constant uncertainty when deciding which notes to accept and which to reject. Everyday commerce became increasingly complicated as trust depended not on a national standard but on the reputation of hundreds of individual banks. Then, international events intensified domestic weaknesses. The War of 1812 placed enormous financial pressure on the federal government. Funding military operations demanded substantial borrowing, yet the absence of a coordinated national banking institution made raising money far more difficult. Treasury officials struggled to secure loans on favorable terms. The financial system lacked the organization required during a national emergency. What had once seemed like a philosophical debate now carried immediate practical consequences. When the war ended, many lawmakers reluctantly reached the same conclusion they had resisted only a few years earlier. Whatever objections existed toward centralized banking, governing a growing nation without one had exposed serious vulnerabilities. Congress therefore authorized the creation of the Second Bank of the United States. Although similar in broad purpose to its predecessor, this new institution entered an economy that had already become larger, more complex, and increasingly dependent upon reliable financial coordination. The Second Bank's early years were disappointing. Weak management, questionable lending decisions, and poor oversight contributed to speculative excesses that ended painfully. Financial conditions deteriorated, culminating in the Panic of 1819, one of the first major nationwide economic crises experienced by the young republic. Businesses failed, property values collapsed, families lost farms and livelihoods, public anger intensified, and many citizens blamed the very institution created to provide stability. Yet history often changes because of leadership rather than structure alone. New management gradually transformed the bank's operations. Lending standards improved. Greater discipline replaced earlier recklessness. Confidence slowly returned as the institution demonstrated that careful financial management could reduce instability rather than encourage it. Over time, the Second Bank evolved into a far more effective organization than its troubled beginning had suggested possible. Ironically, its growing effectiveness produced a new problem. The more successfully the bank stabilized commerce and influenced credit, the more powerful it appeared. To supporters, that influence represented responsible coordination within an expanding economy. To critics, it confirmed their deepest fears. An institution originally designed to protect national prosperity increasingly looked, at least in the eyes of its opponents, like an unelected force capable of shaping the country's economic future. Those concerns found their strongest political champion in Andrew Jackson. Unlike Hamilton, Jackson's worldview had been shaped by frontier hardship, military experience, and personal encounters with financial speculation that had left him deeply distrustful of concentrated economic power. He believed ordinary citizens should never become dependent upon institutions controlled by wealthy elites. As he rose toward the presidency, opposition to the national bank became one of the defining causes of his political career. Jackson did not argue merely that reforms were necessary. He questioned whether any institution should possess such extraordinary influence over the nation's finances in the first place. To millions of supporters, his message resonated because it appealed to fairness, independence, and suspicion of privilege. The stage was now set for one of the most dramatic confrontations in American political history, a battle that would determine not only the fate of the Second Bank, but also whether the United States would once again attempt to navigate its future without a permanent national banking institution. With the national bank gone once again, the United States entered one of the most unusual chapters in its financial history. Instead of relying on a single institution to coordinate banking activity across the country, responsibility became scattered among hundreds of independent banks operating under different state laws. For many Americans, this seemed like a victory for local control. Communities could establish banks that understood regional needs instead of answering to distant officials. Entrepreneurs found it easier to obtain credit, new towns gained access to financial services, and economic opportunity spread alongside the nation's rapid westward expansion. At first glance, the system appeared to reflect the democratic spirit of a young republic determined to avoid concentrating power in a single institution. The reality, however, proved far more complicated. Because each state established its own banking regulations, standards varied enormously from one region to another. Some states imposed careful oversight and required meaningful reserves to support the notes banks issued. Others adopted far looser rules, encouraging rapid expansion with little regard for long-term stability. As new banks appeared across the country, so did hundreds of different paper currencies. A note issued by one institution might be readily accepted in its local community, while being heavily discounted only a few hundred miles away. Travelers, merchants, and businesses constantly faced the challenge of determining which notes were trustworthy and which carried significant risk. Commerce became an exercise in judgment as much as arithmetic. Shopkeepers often consulted printed guides listing the current value of banknotes issued by institutions across the country. These publications changed frequently because confidence in individual banks could rise or collapse within weeks. A merchant accepting payment from an unfamiliar customer had to evaluate not only the amount printed on the note, but also the financial reputation of the issuing bank. Every transaction carried uncertainty, adding hidden costs to ordinary business activity. The fragmented system also created opportunities for deception. Counterfeiters exploited the growing number of legitimate banknotes by producing convincing imitations that circulated alongside genuine currency. In many cases, ordinary citizens lacked the knowledge or tools needed to distinguish authentic notes from fraudulent ones. Confidence, the foundation of every monetary system, became increasingly fragile. Once people began doubting the money in their pockets, hesitation spread quickly through local economies. Some institutions operated responsibly and served their communities well, providing loans that helped farmers purchase land, merchants expand inventories, and manufacturers invest in new equipment. These banks contributed to remarkable economic growth as transportation networks improved, canals connected markets, and railroads gradually transformed the movement of goods across the continent. Industrial production increased, cities expanded, and millions of immigrants arrived seeking opportunity. The American economy demonstrated extraordinary energy despite its financial imperfections. Yet, success often encouraged excessive optimism. Easy access to credit fueled speculative investments in land, transportation projects, and commercial ventures whose expected profits sometimes existed more in imagination than reality. Rising prices convinced many investors that prosperity would continue indefinitely. As confidence grew, borrowing accelerated, and financial risks quietly accumulated beneath the surface. The pattern became familiar. Expansion encouraged speculation, speculation inflated prices, and inflated prices created the illusion that wealth could only increase. Eventually, reality interrupted optimism. A disappointing harvest, declining export demand, falling commodity prices, or the failure of a prominent business could suddenly change public expectations. Depositors rushed to withdraw funds, fearing their bank might become the next casualty. Banks, unable to convert long-term loans into immediate cash, struggled to satisfy anxious customers. As confidence disappeared, healthy institutions often found themselves caught in the same panic affecting weaker competitors. Fear spread faster than facts. These recurring crises exposed one of the greatest weaknesses of the decentralized system. Individual banks could assist one another to a limited extent, particularly within major cities where clearinghouse associations coordinated emergency responses. However, no nationwide institution possessed the authority or resources to provide liquidity across the entire financial system. Local solutions sometimes worked, but widespread panic frequently overwhelmed regional efforts. The absence of coordinated action allowed financial distress to spread from one community to another with remarkable speed. Despite these setbacks, the United States continued achieving astonishing economic progress. Railroads linked distant regions into a national market. Factories adopted new technologies that dramatically increased productivity. Agricultural output expanded as settlers cultivated vast areas of fertile land. Innovations in communication, including the telegraph, accelerated the exchange of commercial information. By the closing decades of the 19th century, the country had become one of the world's leading industrial powers. This remarkable growth demonstrated both the resilience of American enterprise and the determination of millions of workers, entrepreneurs, and immigrants who built businesses despite repeated financial instability. Still, every period of prosperity seemed eventually followed by another severe contraction. Each downturn destroyed savings, closed businesses, and left families facing unemployment with little protection. Public frustration intensified after every crisis because the underlying pattern appeared unchanged. The economy repeatedly demonstrated its ability to generate enormous wealth, yet it also remained vulnerable to sudden collapses that erased years of progress within months. By the early 20th century, many business leaders, economists, and government officials concluded that the existing banking framework had become increasingly unsuited to the scale of the modern American economy. Commerce now stretched across the continent, corporations operated in multiple states, and financial markets had grown far more interconnected than those of previous generations. Yet the institutions responsible for maintaining stability remained fragmented. These concerns reached a turning point during the financial panic of 1907. What began as difficulties affecting a small number of institutions quickly spread through New York's financial community before threatening confidence across the nation. Depositors formed long lines outside banks, businesses struggled to obtain credit, and uncertainty gripped markets already weakened by fear. The crisis demonstrated how rapidly financial problems could escalate when confidence disappeared. In the absence of a government institution capable of coordinating a nationwide response, influential private bankers attempted to organize emergency assistance. Working together, they assessed struggling institutions, encouraged stronger banks to provide temporary support, and sought to restore confidence before panic overwhelmed the entire system. Their efforts helped prevent a deeper collapse, but the experience raised an uncomfortable question. Should the stability of a growing national economy depend upon the voluntary actions of private individuals during moments of crisis? As calm gradually returned, that question became impossible to ignore. Policymakers recognized that temporary improvisation could not substitute for permanent institutions forever. The financial system had survived once again, but survival alone no longer seemed sufficient. The debate was no longer simply whether America needed reform. Increasingly, the discussion focused on what kind of reform could strengthen stability without concentrating excessive power in the hands of either government or private finance. That challenge would soon lead to one of the most consequential political and economic decisions in American history. The panic eventually subsided, but the questions it raised refused to disappear. Businesses reopened, depositors slowly regained confidence, and financial markets stabilized, yet the underlying weakness remained painfully obvious. The United States had built one of the largest and most productive economies in the world, but when fear spread through the banking system, there was still no permanent national institution responsible for coordinating a response. The country had relied on emergency cooperation, influential financiers, and improvised solutions rather than a framework specifically designed to withstand moments of crisis. That realization transformed a financial emergency into a political turning point. In Washington, lawmakers increasingly accepted that the nation could no longer postpone serious reform. The challenge, however, was far more complicated than simply creating another national bank. Americans carried more than a century of historical memories. Many remembered the fierce political battles surrounding earlier banking institutions. Others feared that giving enormous financial authority to either private bankers or the federal government would threaten democratic accountability. Reform would have to accomplish something that had repeatedly failed throughout American history: provide stability without convincing the public that economic power had become dangerously concentrated. To understand how difficult this task was, it is important to remember that Americans were not debating whether money mattered. They were debating who should influence the flow of that money. Every proposal forced lawmakers to balance competing priorities. Business leaders wanted a financial system capable of responding quickly during emergencies. Farmers wanted fair access to credit throughout the year, rather than seasonal shortages that made borrowing expensive. Smaller banks worried about being dominated by larger institutions, while many citizens feared that political leaders might eventually misuse any powerful financial authority for partisan purposes. Every interest group supported reform in principle, but envisioned a different solution. Congress responded by establishing a commission to study banking systems, both within the United States and abroad. Members examined how European countries managed financial crises, organized currency, and maintained confidence during periods of economic stress. Rather than searching for a perfect model, they sought lessons that could be adapted to America's unique political traditions. Those investigations reinforced one important conclusion. Nearly every successful industrial economy had developed some form of coordinated financial institution capable of supplying liquidity when private markets could no longer function effectively on their own. Even with growing agreement that change was necessary, designing a new system proved controversial. Public trust remained fragile, and political leaders understood that any appearance of secret influence or favoritism could destroy support before legislation even reached the floor of Congress. Newspapers closely followed every proposal, while critics warned that powerful financial interests would inevitably attempt to shape reforms in their own favor. Supporters countered that refusing to modernize the banking system would simply guarantee future crises. The debate reflected the same tension that had existed since the earliest years of the Republic, the constant effort to balance economic freedom with financial stability. Eventually, a compromise began to emerge. Instead of placing all authority in a single institution located in one city, lawmakers explored a structure that divided responsibilities across multiple regions while still allowing coordinated national action during emergencies. This approach acknowledged America's long-standing suspicion of centralized power, while recognizing that completely fragmented banking had repeatedly exposed the economy to unnecessary risk. The proposed framework attempted to combine local knowledge with national coordination, creating a system designed to serve both regional communities and the broader economy. When legislation finally passed, it represented neither a complete victory for advocates of government control nor a triumph for private banking interests. Instead, it reflected the distinctly American habit of resolving deeply rooted disagreements through compromise. The new institution would influence monetary conditions, support the banking system during periods of stress, and encourage greater financial stability. Yet, it would also operate through a regional structure intended to prevent excessive concentration of authority. Whether that balance would succeed remained uncertain, but lawmakers believed they had created a stronger foundation than the country had previously possessed. The establishment of the new system did not instantly eliminate financial challenges. Economic cycles continued. Recessions still occurred. Markets still experienced optimism followed by disappointment. However, future policymakers now possessed tools unavailable to earlier generations. During periods of severe financial pressure, coordinated action became possible in ways that had been unimaginable during the 19th century. Instead of relying entirely upon private cooperation or scattered regional responses, national authorities could intervene with the objective of restoring confidence before panic spread uncontrollably through the economy. The debates, however, never truly ended. Every generation confronted new questions about how much influence a central financial institution should exercise. During times of inflation, critics argued that monetary policy had become too loose. During recessions, others insisted that officials had acted too cautiously. Some believed intervention prevented unnecessary suffering by stabilizing employment and protecting the financial system. Others worried that repeated rescues encouraged excessive risk-taking. By convincing large institutions they would always receive assistance during difficult times. These disagreements reflected enduring philosophical differences rather than simple technical disputes. Looking back across the nation's history, it becomes clear that America's financial evolution was never a straight line from failure to success. Each period solved certain problems while revealing new challenges. Decentralized banking encouraged local initiative and entrepreneurial growth, but often struggled to maintain stability during nationwide crises. Greater coordination improved confidence and strengthened financial infrastructure, yet it also generated continuing debates over accountability, transparency, and the proper limits of institutional power. No system proved flawless because every solution required difficult trade-offs. Perhaps the most remarkable lesson is not that America survived without a permanent central bank for more than a century, but that it adapted repeatedly as circumstances changed. Generations of lawmakers, business owners, workers, farmers, and ordinary citizens confronted problems that had no easy answers. They experimented, succeeded, failed, argued, compromised, and gradually reshaped the financial system to meet the demands of an expanding nation. Their decisions continue to influence daily life in ways most people rarely notice, from mortgage rates and business loans to inflation, employment, and the value of the money carried in every wallet. Today, discussions surrounding interest rates, banking regulation, government debt, inflation, and financial crises often appear to concern modern events alone. In reality, they are chapters in a much older conversation that stretches back to the founding of the United States itself. The names have changed, the economy has grown vastly more complex, and the institutions have evolved. But the central question remains remarkably familiar. How can a nation encourage innovation, opportunity, and prosperity while also protecting its people from the instability that unchecked financial panic can create? History offers no permanent answer. Instead, it reminds us that economic systems are living institutions, shaped not only by numbers and markets, but also by values, political choices, and the difficult balance between freedom and security. That balance, debated since the earliest days of the Republic, continues to define the American financial story today.